Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, a part of our business development team here at ICM. And today I'll be joined by ICM's Chief Investment Officer, Mike Paciotti. Mike, thanks for joining us.
Glad to be here.
Great. So let's jump right in. Over the last several years, this has been really, without a doubt, a growth-led market with stocks like NVIDIA and many of the other Mag 7 names leading the broader market higher, while value has really trailed. But 50 years prior to that, there was this clear empirical evidence that value was the dominant strategy. Can you take us back to that, and why, at least previously, why did value have such a clear advantage?
So sure, let me start with sources of return. So for any equity portfolio over any period, I can essentially break down into four components the sources of return and tie out that total return to what happened historically within a few basis points. So those sources are inflation, dividends, real earnings per share growth, and multiple expansion or contraction, which is essentially just a fancy way of saying the valuation change. Now, over any really long period, the sustainable sources of return are essentially the first three: inflation, dividends, and real earnings per share growth. Multiple expansion or contraction, if you start from fair value, should be a zero-sum game. Over the last century, though, valuations have moved from 8 times earnings to 16 to now 20-something or 30-something times earnings. So now some of this is overvaluation, but some of this is a reflection of stocks becoming less risky than they were 100 years ago, right? So as risk declines, less chances of fraud, greater availability of information, multiples go up, and forward-looking return declines. So they go together. Multiples up, future return down. So technically, over the last century, valuations moving up have added to return. But there's no fundamental reason for that unless you think stocks will continue to become less and less risky. Now, over short periods, a decade or less, valuation change becomes really the dominant force. In 1 year periods, the change in valuation of a stock or an index moving from 20 times earnings to 24 times earnings might seem like something that's small, but that's essentially a 20% return on top of whatever inflation and earnings add to the mix.
So, Mike, how does this really relate to growth and value?
Well, the original work on this was, of course, Fama and French. They actually didn't call it growth or value, but they called it glamour stocks and high book to price, with glamour obviously being growth and high book value to price being value. So this is kind of the classic example of tortoise and the hare kind of a race, right? Glamour stocks are just that. There are these exciting companies in dynamic industries generating a lot of buzz and growing earnings at a rapid pace. So therefore, they attract a lot of attention and investor interest. So the primary return source with growth or glamour is the fast-growing earnings, right? So with value, it's basically you're wretched and unloved, right? These are companies that have fallen on hard times or have some sort of a temporary issue. We used to call value investing time period arbitrage, right? You need to see the value beyond whatever the short-term issue might be. Now, value, because of the low price, usually has a meaningful dividend yield advantage, but falls way short on earnings growth. But over time, if they just get a little bit of good news, the multiple, which is so depressed, can expand greatly. And what Fama and French actually found was that growth typically became systemically overpriced due to all of the excitement and would retreat a little bit, while value got enough of a boost and would ultimately win that race, right? Which, ultimately stood the test of time for over 50 years.
Okay, so take us through the last decade, not a short period of time, and growth has just walloped value. Can you talk about that a little bit?
Yeah, so sure. I mean, the last decade was basically a Fama and French nightmare, right? We used to joke that the Nobel Prize Foundation might actually call and ask for their prize back on it. It was so bad. So the dominance of growth was so great during this last decade that it actually wiped away every shred of evidence to support Fama and French's work, right? So there was no discernible trace of value premium ever existed. I mean, historically, it just got wiped away.
Wow.
So what happened What happened in that environment, growth did really have a dominant decade, coupled with it actually becoming more expensive. So over the last decade, growth stocks advanced by an annualized 15.7%. But 500 basis points of that came from growth stocks simply getting more expensive, right? So when we remove that, the gains on growth over the last decade were a fairly pedestrian when compared to the historical market average of 10%. They were just that, a 10% rate of return, stripping out that 500 basis points.
So what about value in this scenario?
Now, value by contrast had an okay decade, gaining about 8% per year over that time period. It also benefited, to be fair, from multiple expansion, but much less so than growth. Now, here's the interesting thing. 10-year earnings growth was nearly 7% per year for growth stocks, but less than 1% for value. Now, the average for growth stocks is less than 4% per year. So this was nearly double the historical average over this period. So in fact, earnings have only been better in about 10% of all environments for growth stocks, that is. Now, conversely, value stocks saw earnings growth at just 60 basis points, nearly a full percent below their average. So this is all well and good, but what we need to realize is that long-term earnings growth are it's a mean reverting series. So what we should see is an acceleration for value over the next decade and a bit of a slowdown, at least back to normal growth rates for earnings for those growth stocks. So when you combine all this together, you get completely divergent valuation pictures, value being cheap with accelerating earnings and growth being expensive with decelerating earnings. And I think the picture becomes pretty clear.
All right. So, I mean, do you think there's an element of being priced to perfection here? And can you expand on that a little bit and how that idea has been playing out in markets so far this year in 2025?
Yeah, I think you're seeing that negatively impact the US as a whole and actually positively impacting Europe. So the US, we were expecting a gangbuster economy with year over year earnings per share growth of 20+% per year. That was the expectation at the start of the year. Now that we see that earnings may not quite get there, multiples are actually receding to levels that support a lower growth story in the US, right? Even though that story is good, prices need to decline because of how expensive things were. It's not quite perfect enough to live up to those lofty expectations that we had at the beginning of the year. So for Europe, it's the exact opposite. They're now starting to see some really positive developments on the economic front. Plus, Germany announced a bit of an infrastructure spend. With as much negativity as there was priced into that region, certainly less optimism than the US, this little bit of good news has really boosted shares in European names so far in 2025.
So essentially, when you think about it, the international stocks and emerging market stocks are basically like the value stocks in fama and French, while the US represents more of growth or glamour. And all of the buzz was about the US. What we're really now seeing is that give back while non-US segments get a boost.
Yes, but yeah, definitely.
All right, so Mike, this runs counter to what many would expect given all the policy uncertainty around global trade and tariffs. Can you talk about that a little bit?
Yeah, sure. Look, I mean, there was so much euphoria priced into the US. Everything else as a byproduct of that was priced with a certain amount of negativity. So that's reflected in the PE multiple. You have on one hand the US priced at 35 times earnings versus EFA value priced at 13 times earnings. So it doesn't take a lot to move a 13x multiple. Likewise, it doesn't take a lot to move a 35 times multiple, just a miss or two. So in the case of Europe, many assumed that everything ex-US would do poorly mainly because of tariffs, right? So the assumption is that tariffs would negatively affect the foreign entity. It's possible, but only to the extent that they absorb the tariff into a lower price or that there's actually some substitution away from their good to another. Otherwise, it's kind of just business as usual.
So, I mean, non-US stocks are up 10+% while US was down 10%. That's a pretty big gap. I mean, really, what happened though?
Well, a few things. Mainly, Germany announced some pretty significant spending plans on infrastructure and defense. Infrastructure is expected to be 1% of GDP, while defense is expected to be an additional 2% of GDP on top of what they were already spending. So when you're priced at 13 times earnings, that moves the dial.
All right. So in your view, what about the dollar here? I mean, if we think back to 2024, it had a pretty historical run in Q4. And after that, the market began pricing in the possibility of a Trump administration. How has that reacted?
Well, it's the same thing, actually. So much U.S. dominance was priced in. That all really needs to kind of be walked back now at this point. So what Wall Street was actually calling for euro parity about a month or two ago. Think about that irony. And the dollar has actually gone completely in the other direction by as much as 5% at one point, to the benefit of those non-US currencies.
All right, Mike, let's lastly jump in. We haven't yet touched on emerging markets, and in particular, China. Investors came into the year pretty pessimistic, despite that big stimulus announcement that they made in September of last year. How have Chinese stocks fared amidst all the uncertainty and concerns, over these new tariffs?
Sure. I mean, well, it's kind of the same thing as Europe. I mean, just a few years ago, as positive as we were on emerging markets, China was not part of that optimism. In fact, we were underweight China until not long ago. Now it's a modest overweight, actually. So now there are still some issues there, right? I'm not sure the property market has the issues there have been resolved. They still have issues with population declines, but the stimulus plan that they announced in the fall was just massive. And there's some, organic green shoots that are showing in the economy, possibly as a result of that. And then you had the whole DeepSeek thing that announcement created a lot of positive buzz and a lot of positive attention. And then what you get is that the market's up 20% this year.
Mike, it's been a wonderful conversation, again, full of great insights. I want to thank you for joining me today.
Glad to do it.
And thanks to our viewers for watching this episode of Mic'd Up with ICM. As always, if you have any questions, would like additional information, or have a suggestion for a future topic of Mic'd Up, please reach out to us at 888-426-4689 or via email at info@icm-invest.com. Thanks for joining.